Evening, everyone. Trinity is an oil producer. We base in Trinidad, so all of the assets are in Trinidad. We are largely all local, so it's a locally led team. The management team is there on the ground, so mind and decision is in Trinidad. And for those who don't know about Trinidad, I'll spend just a quick minute on it. So Trinidad is a very industrialized country. For its Trinidad and Tobago. Tobago is very much more the tourist area, and Trinidad is the industrialized part. Trinidad does around 800,000 barrels of oil equivalent per day, 9/10 of which is gas, and 1/10 of which is liquid oil. So it's a pretty large industry, a large scale going through there. We have a big downstream. We produce some of the most amount of methanol and ammonia globally, and we are the 6th largest LNG producer globally as well. So just to give you an idea of scale, also within Trinidad, because it's such a large basin, it's been producing for over 100 years, you've got people like Shell, you've got BP, you've got BHP, so you've got the majors there, you've got EOG, the largest shale oil player, and you've got small people as well, you've got family-owned firms, and then you've got people in the middle, like Trinity. So it's a wide spectrum, and you've got the supply chain there to support, so you've got all the big names from the supply chain, the Weatherford, the Baker Hughes, the Schlumbergers, and you've got mom and pop shops as well too. So it's an opportunity across a wide scale to be able to look at and drive a value proposition. The yellow assets here, or the yellow areas, are where Trinity operates. So there's the West Coast assets there on land, which is the core business and sits within this giant green blob, which has produced 1.2 billion barrels to date. And that represents about 12 to 20% recovery of that. So there's a lot of oil still to go there. And there's been producing since 1920s, and there's still a lot to go after. We also have this asset here on the East Coast, which I'll get into at the end. But that's also that's where we have an oil development coming through. And it's a bit of a juggernaut of a project. And then you have BP out here. And BP's chief economist was in Trinidad, I think maybe a week and a half ago. And he said that this represents around 15% of BP's global production. So that will give you an idea of the scale of what's happening here in Trinidad. You've got Shell there, you've actually got Shell up here as well. And BHP is off this way here in ultra deep water drilling and has drilled 6 successful gas exploration wells out of 8. So a very high success rate. A bit about Trinity in terms of a summary. So we are local, as I've described. So, all the team is local there. We produce about 5% of the country's liquid oil, and we have line of sight to produce more of that. In terms of we're lean and innovative, we are the lowest cost operator on land in Trinidad, and we are probably the lowest cost operator offshore. I say probably offshore because there are no other public companies operating offshore. There are 3 other public companies on land in Trinidad, and if you look at the published statements that come out, we are the lowest cost, operating cost I'm speaking to there, by a country mile. We are around $11.90 on land, and the next closest is around 14 or 15 US dollars per barrel. And that hasn't happened this interims. That's been happening since 2016. In terms of the assets that we got there, so we are operating and producing from a number of different reservoirs. We're operating across different horizons. We operate different type of lift in terms of artificial lift. So from diversification in terms of the operation, we're not depending on one well. So if one well goes down, production is not going to go down. We manage actually around 200 wells across that entire portfolio. So it's hard work, and we're looking at ways to change how we do that and change the financial metrics as a result of that. Diversified and aligned, I guess the key thing there that I'd like to bring out is that board and management own 23% of this company, with friends and family 40%. So we are just as invested as our shareholders to be able to see this turnaround and get value from this. Just a little bit in terms of the assets, the onshore commercial production began there in 1910, but the onshore assets there, which are, you see the WD13, 14, WD56, it means Western District. Within that giant field, it's almost as if this would be the entire field and our assets would be this little piece in it. So you're drilling in an area onshore, you're producing from an area that has produced for a number of decades, but it's very layered. There are a number of different sands in terms of reservoirs. So you've got the Monlifer sands, then you've got the forest sands, and you've got the cruise sands. And each of those have layers within, up to 3 layers in some instances. So you're not going to drill a dry hole in Trinidad. It's just a question of what your ultimate recoverable will be. And I'll describe that a little bit more later on. Offshore on the East Coast here, we've got the East Coast asset, and that is a different type of reservoir. So on the onshore, it's a gas solution drive. So you punch a hole, and it's a dead tank, and you pump it. On the East Coast, it's a little similar. It's not very high energy. But what we've seen is that on the East Coast there, we actually get some aquifer support. So we get water drive. So we've been producing, and when we go to the production graph, you'll see we've been producing that asset at actually a fixed and a slightly increasing rate without drilling. So that doesn't normally tend to happen because you're producing a finite resource. So the more you produce, it tends to decline. That hasn't been happening on the East Coast. And it's given us a lot of confidence and faith for the oil development that we want to do 800 meters just northeast of there. Offshore on the West Coast, these assets are producing. We've had those for a while. We always focus that every asset contributes, so it's not dragging. Some of our half one highlights and a little bit post-period. In the first half of the year, we did 5 recompletions. And a recompletion really is when you've got an existing well and you've produced from the zone that you went to. But en route, as I described, you're going through layers. So what you do at that point in time is you've depleted that area, you come back uphole, and you recomplete another zone, and you get new oil from there. So that's one of the benefits when you drill a well with stacked pay. You're not having to drill another well to get to there. You're just going back uphole. So the economics on those are fantastic. In terms of SCADA, I don't know if anyone here is up to speed with what SCADA is, but it's supervisory control and data acquisition. It's technology that was typically pioneered in process plants, refineries, those sorts of things. And it was used to control. So people in process plants sit back and they have this command center and they decide what's happening, where they're having issues. We actually starting to use that technology on land in Trinidad. And we've pioneered that with Weatherford. It's never been done in Trinidad on land before. It's been done in the US. There's another AIM-listed company called Diversified Gas and Oil. And they're actually seeing some significant benefits through the deployment of this. They have deployed, I think, close to 60,000 units. We've just started a pilot project on 2 of our wells. So we're learning about this. We've drilled 2 wells post the period end. So after June 30th, we commenced drilling in late July. We drilled 1 traditional low-angle well, and we drilled a high-angle well. And that's the exciting thing, that we haven't really done it. It's never been done in Trinidad, so we actually try to change the methodology. So the way we see ourselves, particularly onshore, is that it's a manufacturing business. And what we're interested in doing, and we came to the market last year and we raised 20 million, and we said, people said, well, what do you want 20 million to do? And we said, all right, great. We want to be debt-free. That's the first thing. So we restructured in January of 2017. And then in 2018, we said, you know what, we've cleared up everything with the exception of our state creditors. So those were the Board of Inland Revenue, the HMRC equivalent, and the Ministry of Energy. So we raised some money for that. We cleared them up 15 months in advance. So that, when you're working with a regulator, it makes you feel a lot more comfortable to have discussions. That has cleared us up. We also said we would raise some money to go drilling. Trinity hadn't drilled onshore since 2013. So this was our resumption to drilling. And we drilled and we grew production. Our year-on-year growth between 2017 and 2018 was 14% growth. So we did that. But we did all of that to eventually become free cash flow positive. Because what an investor wants to see and understand is, okay, great, you've taken your business to the next step. What does it mean for me, though? You're growing your business, that's good. You have to be profitable, but more so than that, you have to be cash generative. And that's the general theme of all we are trying to do. The financial metrics that you see on the right-hand side. So production growth of 9%, revenue up in the face of oil price going down by 2%, operating costs down 9%. So revenue up, operating costs down means your profitability goes up. And one of the theses that we went to when we went to the market last year was to say, we have a largely fixed operating cost base. So throughput accounting. The more that you get over that is the lower that your marginal cost becomes. So every widget that you produce after that, every barrel that we produce becomes cheaper, and you become more and more profitable. So that's what this is demonstrating. We had more production, oil price was a bit lower, but profitability went up. And our profitability, just in case, in terms of our margin, we were 35% this half. So we're not talking about oil sector anymore. Trinity is way past oil sector margins. And this is EBITDA margin. So this is our gross sales, less revenues, less operating costs, less administrative costs. Administrative costs have been adjusted to remove share option expense, which is a non-cash item. And in terms of IFRS 16, if anybody has heard about that, which is about how you treat with leases, we actually kept our lease costs in here for the purpose of comparison. So we aren't using lease costs to reduce our operating. So it's not an accounting trick of the hand. So adjusted EBITDA up by 20%, and on a per barrel basis, actually up by 11%. Operating break even. So what happens when the oil price drops and we go down to $30 or so? Trinity can meet its day-to-day liabilities. So that doesn't mean anybody goes home. That doesn't mean we're saying we need to reduce what we do. We can actually survive at oil prices of $26.30. That's what this is saying. So that's a pretty low break even for an oil company. And again, not just Trinidad, I think globally. And cash plus working capital surplus, again, cash conversion. So at the end of 2018, we were $10.2 million. At the end of the half year, we were $17.8 million. Remember, no debt. And working capital surplus of $4 million on that, that's $22 million there. I'm not going to go through this on the left-hand side, that's for your information. But just to remind that we had adjusted EBITDA of 20% and interestingly, a cash flow. So your cash flow from operations as a function of your EBITDA, 90%. So that's the ability to convert profitability into cash. And you'll keep hearing me say cash, cash over and over again, because that's where we are focused right now. This slide here just really tries to illustrate what is happening in terms of, on the left-hand side, it breaks down our various asset classes, the onshore, west coast and east coast, and then what our G&A or administrative costs are on a per barrel basis. Gives you some detail there, but really just to focus in onto the graph. So I'm sure you guys will read this sort of on the train home tonight. But in terms of the graph here, just focusing on 2019, you can see that our adjusted EBITDA of $21 rose from $19 on a per barrel basis. Just another way of slicing and dicing and showing you the profitability. And the break even went from $28 to 26.3. So the metrics are moving in the right direction. And when I close off at the end, you'll see this is not this half. It's not last half. It's not the half before. It's been about 3 consecutive years and 4 years for that break even. So we're not doing this. This is not a guesstimate. This is something that we have been delivering. In and amongst what we are doing, low operating costs, one of the lowest in Trinidad, in fact, the lowest on land. We are looking at ways to get even better at this. So we think, it's how do you enhance that now? And we're reviewing the business and really looking at quality management. There's an MBA slide later on in here. I'll explain that. But hopefully you get what I'm trying to say in that, we have pioneered the use of SCADA, and it's on the next slide there. So what will SCADA do? It will tighten, it will help you protect your base production. So it'll help you understand more, how do I stay where I am and reduce decline as best as possible? And that's what a company like Diversified Gas and Oil have done. They've deployed SCADA and they're quicker to react. And you change your operating philosophy from being reactive to proactive. And those of you who know about running a business, the more you're proactive and the more you predict, the better you are at cost management. It's the better you are deploying your resources. And that's what we're aiming to do. Protect your base production, enhance it, and change your operating philosophy and reduce your costs, where we are already the cost leaders. So those are operational levers, for example, that we can do. We can also look at the way we drill wells and try to reduce costs there in terms of how we design wells. We can also look at the IPs of wells and try to get higher gross to net ratios. So those are operational levers that any good business should be working on all the time, particularly in a manufacturing business where you're always trying to squeeze the last drop from everything. On the other side, financial hedging. So the financial levers that you can pull as well. Within Trinidad, there's a regressive tax called supplemental petroleum tax. And that kicks in when the oil price goes above 50. So at 50.01 is where it kicks in. And keep that price to the back of your mind because I'll do an analysis on that later on. It's regressive, it's rare, we've been lobbying for change against it. But in the meantime, until it's changed, we can't complain about it. Tax is tax. You can't cry murder for it. So we've figured out ways to try to mitigate and circumvent that. So we've hedged here and we put 2 hedges in place for not downside protection, because if you remember, our break even is already quite low. So what we're trying to hedge is against a tax. So we put a put spread in between 50 to 55, and we put a 3-way, which is a put spread with a call on top. So we're quite mindful of not trying to give away too much upside. So we split those. So the graphic there down below shows that 74% of our production or sales volume is unhedged, but 26% is through the use of 2 different instruments. One on 13%, which gives you clear upside and is a put spread, and we paid cash for that. And the other, you capped at 64.40. So when the oil price goes over there, you pay out in the form of a call. So we're quite mindful that you don't want too much of that because you want to leave as much upside exposure, but you also want to mitigate how much cash you're paying in terms of hedging. So that's why we took this approach in terms of a put spread and a 3-way. But what this does, it means that when the oil price comes into that 50 range, and that's sort of where what WTI is now, we start to get payout that helps us mitigate against the impact of the regressive tax, SPT. Reserves up on the top graph and production down on the bottom one. And in terms of reserves, nothing has changed here since 2018. It's a refresh of that. And our annual report gives a lot more detail here. So you can dig into that if you'd like. But basically, what we're trying to illustrate here is that Trinity has a fair bit of 2P reserves, 25 million, and another 20 million or so in 2C reserves. So we have the pathway in front of us to go after growth. So we're not sitting trying to understand what do we need to buy, mergers and acquisitions. We have it within our grasp. And more importantly, we're very concerned that, it's not about having a lot of reserves, because you may see companies book a lot of paper reserves. The key thing is to monetize those reserves. So we have a metric internally. We should be producing between 5 to 10% of our reserves on an annual basis. Last year we did 4.8%. Specifically, we were focused on the onshore. And the onshore, we actually produced 8% of our reserves last year. So it's monetized reserve. It's real reserves. It's not paper. It's not a desktop exercise. This is real production. And down below, you can see the production graph. It's quite small for you guys to see there, but it starts at Jan 2017 when we restructured up to June of 2019. And it shows sort of an upward trend going from 2,500 barrels to 3,000 over that period. It's your real data. This is what real oil production looks like. It's not a smooth curve. This is it. And you can see, for example, here, that's a big chunk there. That's when one of our bigger wells on the offshore platform went down. And you can see it didn't take time to come back up. Change the pump, switch it out. The reservoir performed immediately. And that's what we're referring to in terms of, if you look at this chunk here, that's the offshore East Coast. And you look at that, that's relatively flat. In fact, it's grown. No drilling. So we're learning some really interesting things there. And it's encouraging us because that's where our next oil field development is. And that oil field development represents about 10% growth nationally, not to Trinidad, nationally. So it's of national interest. SCADA, I spoke about this a little bit before, but basically we partnered with Weatherford to use their foresight technology, which employs the use of SCADA. Just very simple terms, what we're trying to do is get information on a continuous basis. The way we currently run all of these businesses, particularly on land, is that you get an operator, he goes with a pickup truck and he drives around every morning. So he will touch on his wells maybe once, twice, 3 times a day, depending on if it's a high productive well. And he's looking at 3 times a day, checking out, making sure everything is all right, if it's working, if it's still producing. So we thought, we want to get even better at this. We want to understand more of what's happening. So we looked at continuous monitoring. And Weatherford is one provider. There are a number of providers globally, and those providers are in Trinidad. So we're looking at everybody. But we partner with Weatherford, put it on 2 wells, one on a progressive cavity pump, which is really an Archimedes screw with a motor on top that just lifts soil. And the other is a nodding donkey, which you are all probably more familiar with. So we're trialing it there. It's never been done onshore in Trinidad. And you think, I wonder why. So what does that do? So instead of a guy coming once a day or twice a day, we have a system here that tells us and monitors that well every 10 seconds. And then every 12 minutes or so, it captures all that information, looks at the algorithms and says, what should we do? Should we speed the pump up? Should we slow it down, depending on the inflow? So if there's a lot of fluid, speed the pump up and produce more. If there's less fluid, slow the pump down so you don't dry pump. And all that information is coming to, well, it's not coming to my phone as yet, but you can do it from anywhere in the world. So you can run your field theoretically from anywhere. So you change the way in which you do things. So the guy who's going around, going to every well, you're now going to tell him, go to these specific wells because they need help. So it changes the way they operate. It changes what you want from them, because now you're not trying to get that information. You're trying to tell them, you become the electrical, you become the instrumentation, you become the mechanic. So you're training up people and you're bringing people as you come. And it's really important in a business that you give all your stakeholders the opportunity to grow. And we think that this is an opportunity for our people to grow. What we've seen so far in this test is quite encouraging. The pilot is showing us that there's so much more that we don't know and so much more that we need to learn. And it's great. And again, we're not starting here from a position of ground zero. We're starting from being the leader onshore. So by increasing production, protecting it through the system, and changing the operating philosophy, you're increasing the margins again. So it's all about profitability, growth, and cash conversion. The high angle well. So typically in Trinidad and Tobago, wells that have been drilled have been low angle, so vertical or low angle. So sort of between 0 to, let's say, maybe about 20, 25 degrees. And we've got a little cartoon on the bottom that shows, so the green is the oil reservoir, so you see that sort of dipping diagonally, and you see what a vertical well will look like, just a straight straw punching through that. And then you see what a high angle well looks like, and that's what we just drilled, is the well that goes in, and you can see there's more exposure between the wellbore and the reservoir. So you're trying to get more pay. So that's what I guess the geologists say. I'm an accountant, so that's what the geologists say. You're trying to get more exposure so you get more of the reservoir and you produce more. So that's what we just drilled, and I'll come on to that. And then eventually you want to get to horizontal. So it's not horizontal to the horizon, it's horizontal to the reservoir. So this here just shows that you're getting there and you just stay within that reservoir. So we just drilled a well called FR1807, and on the top left-hand side is the drilling versus day curve. So you can see this is depth coming down as time. The gray is what the plan was, and the red is the actual. So we actually came in a bit better than was planned in terms of drilling. We came out a day in advance, so that's good. But it took a lot of time to plan because it's a new methodology. So we can drill and punch vertical low angle wells pretty easily. This is a change in methodology, and it takes a little bit of time to get up that curve. But we drilled that. The guys did a really good job of taking care of the well. They really babied it, and it allowed us to log the well and get some extra data as well too. So good success on that side. In terms of the actual logs and the pay, as you guys probably know as well as I, this is what you typically expect in terms of a vertical well. And this is what happens. So you got that expanded because you just changed the angle of entering the reservoir. So from a comparative perspective, we said for a vertical well, this would have had 260 foot of pay. We actually got 398, a little bit more than was planned. So that's good. In terms of gross pay, 600 to 850. And we hit the tops of the sands as planned, 1880. And the TD was 12 feet off what we planned. So the well came in very well in terms of drilling, in terms of the prognosis. We only completed it a few days ago. So the well is just settling up. It's way too early to tell you the results. It looks good, but I think we like to give it maybe a month or two, see the well settle up, understand how it's behaving, and then report to the market as to what it looks like. But this could be a point in time for us to stop and reflect and say, if you're deploying capital and you're doing it one way, traditional low angle wells, and you see that there's an opportunity to increase your returns, this goes up the creaming curve. So you should stop, look at your fiduciary duty, and determine what's the best way to spend my capital. So this, when we start to learn about it, might be a point where we say, hold on, let's just pause on drilling for a little bit. Let's understand, let's look, let's learn, and then deploy capital in the best way possible. This is a pretty interesting one because, as I said before, we raised money, and back then we told the market at $60 oil price, we would start drilling, we would grow production 10% year on year, and that 10% production was really to drive free cash flow accretion. So we said we'd like to be free cash flow accretive by 2021 with $60 oil price. We're actually probably going to be free cash flow accretive in 2019 with drilling. And I'll tell you a little bit about that story. It's through better profitability, as you've seen. So we advanced that, but we actually now started to take that and wrap everything with, continuous monitoring, drilling high angle wells. What does that all mean in terms of a value proposition? And we said, let's look over a 5-year period. And let's say we drill 8 wells every year. So deploy about 10 million in CapEx. What can we do? Can we do it, first of all, across a broad range of prices? And this is what this attempts to show. So it says, this is me doing nothing is blue. And I just sort of stand still, so my cash doesn't really go anywhere. And this is me now investing 8 wells over a 5-year period. You can see at $49, I go from a factor of 1 to 3.5. So in terms of simple numbers, if that was 10 million, that would now be 45 million that I would accrete. So that's a lot of cash with investing. This is not harvesting mode. This is investing, growing production, and churning out cash because your underlying cost structure, your underlying business model is very robust. I'll come back to this one here because this is clearly the special one. At 55, it's a little bit less, 60, 65. For those of you who don't know, this curve, which seems a bit strange because you think as oil price goes up, everything should just keep going up. It's representative of what the supplemental petroleum tax is doing. So I said, remember 5001? So at 5001, it kicks in. It's at its worst. It's at 18% on land and 33% offshore. So it's quite punitive, and it's off of your net revenue line. So it's not even a bottom line tax. It's almost like a royalty. So it's quite hefty. It was put in place in the 1980s when $50 was super normal oil prices, and the big companies in Trinidad, like the Texacos, were making a lot of money, and the government decided to step in to try to get some of that. So that didn't quite change much, and the world has changed since the 1980s. So it is anachronistic, and we are lobbying for change. But lobbying for change and not knowing what will happen, I can't come and speak to you guys and say, everything's fine, we'll drill. Because you'll say, well, what happens there? You wouldn't drill at 5001, would you? And we'll say, based on that, no, we wouldn't. And we don't think that's good enough. So we looked at it and we said, let's now examine this and see what we could do. Now, bear in mind, this contemplates the oil price being at 5001 every day for 5 years. It's very unlikely that'll ever happen. But it is the worst case scenario. And we decided, let's plan the business for that. So that's what we did. We looked at this down here, and these are the levers. So I'm taking this from here, I'm propping it here. So basically, I'm drilling 8 wells a year for 5 years. In real life, if you're not accreting cash, you're not going to do that. But we said, no, we have to be able to come and say, we will drill and we will accrete cash. So that's what's happening. That yellow is the drop down. So it's not a good financial decision to make that right now. But how do I ameliorate that? Well, I can look at the operating levers that I've just described. So look at continuous monitoring, enhance my base, optimize it, reduce my operating costs, change the way I drill, and change the way in terms of how I interpret the subsurface and get better and better at that. Those are within our gift. So we could change that. So we could say, with that lever alone, we are cash accretive. And that takes across all of these. So that's not just in this case. That actually goes across every single other case here. And it's actually more than. It's not just a like for like. Because as the oil price increases, you leverage more. So this is actually sort of making sure that this business is very robust across a number of oil prices. I've modestly included what high angle wells might do there. And that's just simply changing the amount of vertical wells we do each year and slotting in a couple of high angle wells. That's not going all to high angle wells. So this is just a nice 25% increase in terms of what your cash flow could be. Financial levers, as I've described, in terms of hedging against SPT, that takes you up again. And that's something not entirely within our control. It's market driven. But when the market comes about and it allows us to, we will take that and lay up, keep going on a going forward basis. And finally, a modest illustration of what SPT reform would look like. So we think that there are a number of ways to get out of this. And we thought after seeing this and knowing what we can do and what we have been doing, we think it's time to start to demonstrate to shareholders that there is line of sight on free cash flow, or yield, as my chairman likes to say, yield that you can choose what you want to do with it. Grow the business even more than drilling 8 wells a year. And bear in mind, 8 wells a year is just a proxy. You can drill 4 wells a year, you could buy some production, you could try and enhance oil recovery, experiment, you could do a number of different things. It's just to show you that if this business is working, it can work across a number of oil prices. So we're quite robust and we're quite confident to say that even at 50.01, so from this business can generate free cash flow regardless of SPT. And we can drill from low 40s, come up. Clear line of sight. And we thought making that point to you all is very important at this stage. This is a 3D view graph of the East Coast assets. So if you remember, just an inset there on the East Coast assets, just drilling in a bit more. This is what it looks like. So we are currently producing 1,200 barrels from here across these platforms in the Trinidad field. We drilled an exploration well in November of 2013, and that found 186 million barrels of oil in place. So that's a discovery. We don't need to appraise it because there are a number of appraisal wells on either side. So what we are focusing on doing right now is putting together a field development program to put this new platform, Echo, in. And that Echo platform on its own, as a phase 1 of a development going up here, can increase production by 5,000 to 6,000 barrels on its own. It's a big project. It'll require a lot of capex. It'll require us taking our intellectual capacity up, and that's what we've been doing. So we've been spending some time working that project up. It's quite material for us. It's quite material for the country. And we partner with the National Oil Company here as well. So we are 65% in that area, and the National Oil Company is 35%. So we're looking at ways to bring that project to fruition. And as I said, it's quite an intensive project. It's probably going to cost us in the vicinity of maybe 120 to 160 million. But that's if we decide to go about doing it. Our main plan right now is step 1, work the project up, understand what it will look like, get it as close to final investment decision as we can, and then have a chat and understand, who might be interested. How could we go about getting the most value for our shareholders from this? So it's a little way from doing that, a few months or so, but we brought it up now to be able to illustrate this is coming along in the background as well too. So there's a 10% growth year on year, but more importantly, free cash flow growth. And then you have this that we want to take to FID, final investment decision, sometime within the very near term, and then come to market and describe what that will look like. What will that project look like in terms of the economics, NPVs, IRRs, paybacks? What will it look like in terms of funding? So you guys are clear that we're not coming back to the market to try to look for funding for this, because a standalone project should be able to get project financing. So we're looking at different ways to unlock the value there, but we think it's really interesting. And again, it's another way that it's differentiating Trinity from the other players that you might see, because we're not only onshore, we're also offshore. We have the ability to do complex developments, which then sets you up for other things. So you're not just playing in one playing field, you're playing in a couple. This was the MBA slide I meant in terms of sort of operations, production, and financial, in terms of change your operational philosophy, it'll impact your production and eventually financial metrics. And that's everything. That's all you guys care about. You don't want to come here about all the great things we're doing for people alone. You want to hear at the end of the day, how is it driving value? How is it giving free cash flow? So we can come and say to you guys, we're looking at dividends, we're looking at share buybacks. That's the sort of things we think you might be interested in hearing. And finally, to wrap up very quickly, sorry, you can look at this, but the main thing I'd like to take from this is our break even for the last 4 years, sub 30. And just to wrap up, strong production platform, as I've described, robust financials, and a large opportunity set. Trinity is debt-free, cashed up, ready to go, and we can drill and grow production and free cash flow over a broad range of oil prices. Over to you guys in terms of any questions for me.
Who owns your shares?
We are, as I said, board and management 23%, another 17% on top of that to make it 40 for friends and family, and then roughly sort of, I would say 30-30 between retail and institutions.
So you're expecting to, you're saying you're cashed up, you're about to be profitable. What's the attitude towards dividend paying for the future? Particularly, I'm guessing, given how invested the board and friends and family are, when you expect to start paying dividends, if that's in sight.
Well, what we're trying to demonstrate is line of sight to that. We didn't come out here and say, the dividend policy is X, Y, Z, and we'll start paying then, because we think, it's something that we like to develop a bit more. Galeota is an area that we want to get clear line of sight on as to what the funding mechanism is there. And we think by demonstrating that, you then have clear line of sight as to what we're going to do. But the board, and we had a board meeting on Monday, it's something that we speak about at every board meeting in terms of we want to do that because our board is, as you know, owns 23%. So we're just as eager as our shareholders to be able to get some sort of return from this stock.
What's the timeline for Galeota?
Good question. We'd like to be able to come back to the market somewhere within the next 6 to 9 months to define what I've just said. So I would say that time frame, but I'd say 6 to 9 months as a rough guide.
And Jeremy, would you mind just speaking a little bit history, because there was a checkered moment that I think is worth just re-explaining, if you wouldn't mind, where the company's been.
Sure. So in 2013, Trinity went public. We reversed into a company called Bayfield, and they held the East Coast asset that we just described there. And things didn't go financially well there in terms of that company. It took us a little while to adjust to absorbing that asset and that culture. And we drilled an exploration well there. It was a success, but it overran. We drilled another exploration well on the West Coast. That was a dry hole, and that overran as well too. So cost control and drilling at that point in time was absorbing a lot of cash. The oil price started to go down, and we had a break even. You can see there, this gray with red dotted outline is the break even of the business. So the break even of the business at 2014 was $63, and the oil price in 2014 started to go down. 2015 it continued, and in 2016 February is where it reached its lowest. So we actually were in a position where the working capital of the business just was actually overhung. When we took over this current management team in October of 2015, the working capital overhang was $33 million US. So it was a big hole. We then looked at changing the cost structure of the business, and you can see we took the G&A, for example, was in sort of $13 a barrel. We took that down to $5 a barrel. We've held that constant. We took the break even of the business sub 30, and we've held that constant still then. So that allowed us to actually go to investors and say, look, we fixed the operating model, the balance sheet needs fixing. We've spoken to our creditors, they're willing to take some terms. Are you happy to support us in this basis? So we did that January 2017. We cleared up all senior debt, and we cleared up supply chain. All was left was the state creditors that I mentioned before. And since then, we've just looked forward. We've cleared up debt last year. As I said, we're raising 20 million. And our profitability, our break-even has remained, static below 30 for 4 years, and profitability has grown over those 4 years.
Jeremy, thank you very much indeed.
Thank you.